JPMorgan just laid out a clear roadmap for where the next wave of crypto capital is likely to come from this year, in 2026. And the earliest pressure is already forming and taking shape now. Most people are still staring at the Bitcoin chart asking, why does it feel like nothing is happening? That question misses the point. And if you're here watching my video, most of you are long-term holders. So congrats. I know you're not asking this question. The most important shift in crypto right now is not showing up in the price first. It shows up in the market structure. It shows up in who controls liquidity, how capital enters the system, and who has the ability to deploy size consistently. By the end of today's episode, 3 things should be very clear. First, what JPMorgan says is driving crypto inflows and why 2026 could be even larger. Second, why Kraken argues this cycle behaves differently when demand is real. And third, the specific signals that tell you when this capital flow stops being absorbed and starts pushing price. And before we jump in, remember, none of this is financial advice. This is macro context to help you make better decisions. That's it. JPMorgan expects crypto inflows to rise further this year, 2026, after a record $130 billion last year, 2025. Their analysts actually estimate that nearly $130 billion entered crypto markets last year, and they expect that figure to grow again, this time driven primarily by institutional participation. This is not a narrative call. JPMorgan aggregates flows across multiple channels. ETF inflows matter because they represent a frictionless on-ramp for traditional portfolios. CME futures positioning matters because it reflects institutional hedging and directional exposure. Venture capital funding remains another leg. And digital asset treasury purchases, corporate balance sheets allocating to crypto, were a major contributor. JPMorgan estimates that more than half of total inflows last year came from treasury activity. This is the key signal. A large share of capital did not arrive through speculative retail demand. It came through balance sheet decisions and structured allocation. They also know that treasury buying slowed later in the year. That matters. The story is not uninterrupted acceleration. The story is that new capital channels emerged, and those channels are still developing. So keep that in mind, because Kraken helps explain why price can remain restrained even as access expands. Kraken frames 2026 as a shift from hype-driven cycles to structure-driven markets. Their global economist, Thomas Perfumo, argues that Bitcoin still reflects macro risk appetite, but that the mechanics of demand have changed. Spot Bitcoin ETFs, treasury companies, and institutional vehicles now dominate how liquidity enters this market and how price discovery occurs. Those channels behave differently from prior retail-led cycles. Kraken highlights a counterintuitive reality. Last year, in 2025, these vehicles represented nearly $44 billion of net spot demand. Yet price performance disappointed relative to expectations. And the reason is in supply. Long-term holders provided much of the inventory. A market can absorb large inflows without producing reflexive upside. That's why so many participants feel disoriented. They are applying a historical playbook to a structurally different environment, a different market setup. Kraken also ties this back to macro conditions. Sticky inflation, slower policy easing, and modest growth can produce periods of apparent calm while risk builds incrementally. So far, we have 2 aligned observations, and JPMorgan sees a durable capital tide forming into this year. Kraken sees a market capable of absorbing that demand without immediate repricing. The unlock is not a single event. It's sequential. Now, both JPMorgan and Kraken point to regulation as a critical catalyst, a key focal point. point. Stablecoins sit at the center of that transition. Goldman Sachs reinforced this view when CEO David Solomon confirmed the firm is actively exploring tokenization and stablecoin use cases while monitoring U.S. market structure legislation. He also noted growing interest in regulated prediction markets, particularly under CFTC oversight. This distinction matters. Large financial institutions move through regulated channels first. Stablecoins function as a settlement infrastructure between traditional finance and crypto-native systems. You can see this transition in real time in practice. Interactive Brokers is launching 24/7 account funding via USDC, with additional stablecoin support planned. This is not a crypto feature. That is a banking feature delivered through blockchain rails. When money settles continuously, crypto shifts from a speculative asset class into financial infrastructure. That transition is incremental, not theatrical, but it does change everything. Now, let us widen the lens. This is not only a Wall Street story. It is also a distribution story. One of the more unusual developments this week came from an Ethereum treasury firm investing $200 million into Mr. Beast Industries. Mind you, he's recently partnered or been sponsored by BlackRock. That's a separate topic. So I feel a little bad for him, and I'll just be watching him and hope everything works out fine. Anyway, at first glance, it looks unrelated, but it's not. Creators are distribution engines, and distribution drives consumer behavior. Consumer behavior turns infrastructure into habit. Treasury strategy is evolving beyond passive holding. It is expanding towards access, influence, and user funnels. That is how adoption compounds gradually and then suddenly. You also see consumer-level experiments emerging. Carrefour offering Bitcoin payments discounts across thousands of stores may be early, uneven, or promotional, but the direction matters. The rails are extending into daily economic activity, which brings us to the real question for holders. When does this structure translate into repricing? The answer lives in a small set of signals. So let's make this operational. Signal 1, stress among recent buyers. Short-term holder MVRV drawdowns have been materially shallower this cycle than they were in 2018 or in 2022. That suggests stress has not yet reached historical extremes, consistent with a structurally supported market. Signal 2, the short-term holder cost basis. Reclaiming this level typically marks the transition from recovery to momentum. Failure to reclaim keeps price action fragile. And signal 3, the weekly trend divider. The 50-week exponential moving average remains a widely respected inflection level. Acceptance above it tends to reinforce trend confidence. Rejection keeps positioning cautious. Signal 4, broader risk appetite. Market breadth has expanded meaningfully, with a large percentage of S&P 500 stocks trading above their 200-day moving averages. Small cap participation matters here. When capital rotates beyond mega caps, higher beta assets tend to benefit. Signal 5, relative performance. Bitcoin has re-entered the top tier of asset class performance. Leadership matters because it reframes portfolio behavior. Cycle frameworks also deserve attention, but only in context. Business cycle inflection points have historically coincided with Bitcoin's strongest advances, but they work best when aligned with liquidity, structure, and access. Now, let's address the constraints. Kraken's caution is important. Periods of calm can mask deferred volatility. Liquidity conditions can tighten quickly. Treasury-driven demand is not infinite. Equity issuance becomes more difficult when premiums compress, which can slow balance sheet expansion. Regulation acts as both catalyst and headline risk. Geopolitical developments can reprice risk assets abruptly. Political narratives can shape access, and access shapes flows. These factors do not negate the trend. They define the path. So here is the core takeaway. JPMorgan describes a growing capital tide into this year, 2026. Kraken describes a market structure capable of absorbing that demand differently than prior cycles. Stablecoins are evolving into settlement rails. Large banks are testing tokenization. Treasury companies and institutional vehicles now influence price discovery. And distribution is expanding beyond financial markets. That is why flat price can mislead. Over the past year, Bitcoin went essentially nowhere, while custody frameworks advanced. Reserve policies emerged and corporations accumulated, all while institutional access expanded. A market that absorbs adoption without repricing is not broken. It is compressing. What matters now is who still has supply to sell and whether access continues to widen. So watch the short-term holder profit line. Watch the weekly trend divider. Watch market breadth and small cap participation. And watch whether institutional access continues to expand quietly. Because once access is fully in place, price usually stops debating fundamentals. So that's it for today's video. If you gained value, then just like the video and share it with a friend or family member that you want to know what is going on in this market. I love you guys so much, and I'll catch you guys here on Monday. Have a wonderful weekend. Take care.